You're listening to the Be Better Off Show by Kelly+Partners.
Welcome to the Be Better Off Show, where we try to have information that is helpful to our clients to make them healthier, wealthier, and wiser. And today we're going to discuss the Australian federal budget for 2024, released last night by Jim Chalmers, Australia's Treasurer. And I'm very pleased to be joined by our Head of Tax Consulting, Tony Nunes, and his colleague and tax consulting partner, Lishi Huang, to discuss the budget. Welcome, Tony. Welcome, Lishi.
Thank you, Brett.
Thanks, Brett.
Hey, so great to have you. Last night, the government had the difficult task of introducing measures that would address Australia's cost of living concerns without overstimulating an economy that the Reserve Bank has been desperately trying to moderate through multiple interest rate increases to attack inflation. Tony, how do you think they've gone with that difficult task?
Well, look, this has never been a government that's going to introduce significant tax reform. A few years ago, Bill Shorten lost the unlosable election, and the opportunity to make significant tax reform is normally in the first year when you come in and become the government and win the election. That opportunity they didn't take. So the year before an election, you're not going to introduce significant tax reform. You're not going to introduce significant changes. And this was never expected to be a budget where we're going to see anything like that. So
steady as she goes, get ready for an election, and don't upset too many people.
That's exactly it. And we've seen, them sort of not introducing significant changes. Everything that was in there was expected, and they haven't done anything that is going to surprise everyone and surprise business. The themes.
So,
yep. The
so
themes
adding
are
$9.5 billion, I think I read, to the spend. The commentary is that interest rates aren't about to come down as a result, but they might stay a little bit elevated for longer. Getting into the significant things that have happened, changes to individual tax rates, small business instant asset write-off, further support for the ATO tax compliance program, changes to the CGT regime for non-residents, and increased scrutiny on royalties paid to non-residents. These are the things that we've really called out in our summary that has been emailed to all of our clients overnight. Do you guys want to take us through those 5 big measures, sort of one at a time, and share your views?
Yeah, so let's start with the personal finance changes, and this is the stage 3 changes. So this was announced by the previous government, and if you recall, coming up at the end of last year, there was a lot of talk as to whether promises were going to be broken, whether the new government was going to continue with the stage 3 tax cuts because it was going to cost the economy in the order of $3.1 billion. And in January, the Labor government tweaked the stage 3 tax cuts, and I think they played their hand pretty well, because they targeted more towards low and middle income tax earners. So they tweaked that and announced that then in January, and this is now being confirmed in this budget.
Yeah, a little bit of movement in the thresholds in the sort of 32.5% bracket falls to 30%, but importantly, the threshold goes from 120,000 to 135,000, and then at 37% rate up to 190, and then 45% 190. Those threshold moves should bring a bunch of relief to people in those brackets, protect them from the last few years' bracket creep with this high inflationary environment. They could have gone further, but that's at least a start. I notice here in the summary that we've prepared, you've called out an increase in the Medicare levy threshold. The significance of that, what are they up to there?
Well, again, that's just ties into the sort of stage 3 tax cuts. So there's about a 17% benefit to sort of lower tax, the sort of lower income earners. But again, it just ties into the stage 3 tax cuts, and they're following through on that. So typically when you see a change to the personal income rates, there's an adjustment to the Medicare rates as well.
Great. Now into business finance, abolishing tariffs to streamline business costs. I hadn't heard much about this before the budget. What can you share about that, and how will that impact clients?
Well, those are the tariffs on import duties. The government's announced that there's a range of products that are attracting these import tariff duties. Again, it ties into the cost of living, so that increases the cost of these products that are imported into Australia. When you look at the numbers, though, the income that the government is losing from these import tariffs is pretty small. So that's why they've actually referred to them as nuisance tariffs, because all they're really doing is creating a lot of red tape for business and not generating much revenue. So the government just decided to make the import of these products more efficient, and also at the same time help with the cost of living crisis.
Terrific. Now, Lishi, continued focus on multinationals. What can you share with us here? What's happening here?
So probably comes as no surprise to multinationals that the government is continuing to focus on revenue and income and making sure that they pay their fair share of tax in Australia. There were a couple of, big ticket items for clients in that space. The first one is there was previously announced a measure to deny deductions for essentially royalty payments to low and no tax jurisdictions. The government's not going to go ahead with that anymore, but it's going to be wrapped up in the new minimum global tax and minimum domestic tax regime that's come out of the OECD. That is still in consultation, so we don't know very much about exactly how that's going to be implemented. But the idea there is to ensure that it's a fair playing field across the board for different countries, and that there's a minimum tax of 15% for all of these multinational enterprises.
Very interesting. So I think the headline corporate rate in Australia is 30% for our clients who are largely small and medium-sized businesses, but
that's right.
Might only be 15 for the big guys. Very interesting. So this new penalty for undervalued royalties, largely applying to just big groups over $1 billion in revenues. So if you're a client and you fit into that class of or that category of turnover, $1 billion or more, you need to talk to Tony and Lishi's team. In terms of strengthening tax compliance, the government's provided an additional $187 million to target tax and superannuation fraud. Increased personal income tax compliance program has been extended. The shadow economy targeting cash payments has been extended. ATO tax avoidance task force has been extended with the mandate to go and find another $2.4 billion. So there is a huge amount of compliance activity and a commitment from the government to increase funding in that area. They get, I think I read, Tony, 3 or 4 to $1 return on the investment that they make in that space. So they're pretty keen on that. Now, for many of our clients, the extension of the instant asset write-off to 30th of June 2025, can you explain that for us, Tony?
Yeah, so the instant asset write-off was introduced last year. Interesting enough, it hasn't actually been introduced as legislation. It's still in a bill format, but they've now extended it by another year. So hopefully this means that it's here to stay permanently. But what it is, it's really a measure to allow small businesses to claim a write-off for any assets that they buy that are less than $20,000. It's on a per asset basis, so it can add up very quickly to a significant cash flow benefit if you can immediately claim your asset as a deduction. So we have
and that's if your annual turnover is under 10 million for a
That's
client
right.
that has multiple companies that are in a consolidated tax paying group. Does the consolidated group need to be under 10 million or just an individual entity?
Yeah. Look, it's a sort of group-wide turnover basis. So it's not just whether you on a tax consolidated group, which is considered a single taxpayer, but even if you in a non-consolidated group, the turnover is the turnover of all the entities is taken into account.
Great. So that's a is certainly something every client who meets that criteria should be talking to their partner at Kelly+Partners about accessing. And finally, the strengthening of the foreign resident CGT regime. What's this all about, guys?
I'll let Lishi take that one.
So that was actually a bit of a surprise in the budget. At the moment, foreign residents are only taxed in Australia on certain types of capital gains, largely related to real property assets. The budget kind of snuck in that they were going to have a look at this and potentially change the asset pool that's subject to tax, and also change some of the rules around indirect interest in real property and how that's going to be subject to tax. So again, there's not much information in the budget in terms of how that's going to impact clients, but certainly we would be looking at the space quite closely to see what flows from it. I expect, based on the numbers, it doesn't look like the changes are going to be extremely significant. I think the estimate's about $600 million over the 4 years. So we're not expecting wholesale changes to those rules, but it will be interesting to see what changes are ahead.
Yeah, very interesting. So that is tax on real property. Is that correct?
That's right.
Yeah. So direct and indirect interest in land and assets deemed when residency ceases.
That's right. So real property, other things that are deemed to be real property like mining rights, interest in permanent establishments that are set up in Australia. So it's not just real property in that sense, but there are rules that limit the taxation of non-residents in relation to Australian capital gains, and those are the rules that the government's looking at.
Yeah. So taxable Australian property, TAP. That's one to keep in mind and one to speak to your Kelly+Partners director and our senior people in our tax consulting group, Tony and Lishi.
So Brett, there's probably a couple of comments about what's not in the budget.
Yep.
So
and what's not in the budget that should be?
Yeah. Well, not necessarily it should be, but certainly things that could affect our clients. So I guess firstly, you notice that there's been no changes announced to super. So super has been one of those areas where government has introduced significant changes over the last few years. And those changes have been mostly aimed at sort of high wealth individuals. Now, this budget had no changes to super. So are they telling us that they're going to cease these tweaks to the super? Because super, of course, is really hard to change. The idea of super is that you put your money in super and it's locked in there. So when government changes the rules, there's very little you can do without suffering significant penalty. So
I think on that, Tony, that they've introduced such significant change, they need the system to catch up with the changes. Even the accounting, just for the changes they've made, need a couple of years to roll through. And I also think with an election coming up, they probably need a few people that have got, a few dollars in super to vote for them. They've basically alienated anyone with a self-managed super fund over, 5 cents. And so maybe they're trying to get a few people to get a bit of amnesia about what they've done to them and vote for them.
Yeah, I think that's probably on the money. The other thing that's interesting is Division 7A. They've announced many years ago that Division 7A was going to be reformed, and we've had a number of reviews about Division 7A and recommendations, and nothing's happened. So it does leave us still in the lurch in working out, do we still have Division 7A as a planning tool? Because 7 years is a long time to be locked into a loan, and if you go for a 25-year loan, and the rules change in a year or two's time, it's very difficult to change that. So again, there's been no announcement, no guidance on what is happening in that very important space for our clients.
Yeah, again, I do think that the present government's preparing for an election, and they know that they lost the unlosable election when they alienated people through what were perceived as aggressive and unfair tax changes. So I do think they're trying to shrink the number of people that might react to those sorts of proposals at this point, Tony. That's how it feels. And obviously you're into complex, tax law that has long-ranging implications, as you've indicated. So, I don't see any courage across the political board to do anything interesting with respect to tax reform. And so anything that looks a little bit long dated or a little interesting, I think, is just being put to the side. There's a lot of pressure from the Greens for, significant action on the sort of on housing and rental affordability. I do think there's plenty in this budget to try and at least acknowledge government's role in social housing and other reforms that might have an impact in that area. In particular, this calling on universities to provide more housing for overseas students that they seek to bring into the country. Most of these universities are in city areas that are already experiencing real shortages in terms of home accommodation, and so it seems to be a range of measures across that issue in particular that I think the politics of that is to blunt the Green sort of attacks on the Labor Party in that area. So look, the politics of the budget are probably more interested are probably more interesting than the economics in this instance, and it'll be interesting to see how this goes down with the public generally. I want to thank Tony and Lishi for their time. I hope this is an episode that people enjoy. There's plenty more to discuss, and we might do another episode or two over the next week to see to hear some different views on these matters. But as I love to say, have a great day.